In part one, I talked about how affordability hasn't improved, how HELOC debt in the last 5 years of the Bank of Canada policy have jammed up the property ladder. Today, in part two, we're going to talk about where we are now. Specifically, how banks are quietly changing their approval criteria, vendor take-back mortgages, and foreclosures. Now, before I start, I want to acknowledge how difficult this is for so many people. Each statistic that I reference represents a person. They could be your friends, relatives, people you know in the community going through these struggles. And the truth is, we never really know who is struggling or not. And that's why we need to treat everyone with respect and grace. Something you probably don't know is that I am not monetized on any of my channels. I am deeply against selling to people, especially in economic times like these. I have no sponsors, no affiliate links, and no paid partnerships. That said, I do have two links posted under this video, one for a nonprofit credit counseling and another for free mental health support. People have a habit of suffering in silence where financial issues are concerned, and I want every person who watches this to know that they don't have to. Again, I gain nothing from you clicking those links. I cannot track them whatsoever. I do not know who does or does not click them. I do not even know how many people click them. I just need to know for myself that alongside these difficult stats, I did what I could to help if anybody watching this needs it. On to the topics of the day and where we are today in housing. Let's start with lending. One of the big banks recently adjusted its internal mortgage lending policies for borrowers working in steel and aluminum industries. They lowered their debt servicing threshold from 44% to 42%. And this isn't just a temporary shift. It marks a deeper change in how banks are evaluating Canadians, not just based on what they earn, but how predictable that income may be, thanks to things like tariff exposure that they can't control, and whether the sectors they work in might be at risk months or years from now. This has ripple effects because once one bank starts tightening, others will follow, and it won't stop at steel and aluminum. Any job can be seen as economically at risk, could be flagged, whether that's construction, manufacturing, logistics, or even the public sector. Your income may be steady, but if your industry isn't, the bank can treat you as a risk. And when that happens, it closes doors. People who might have refinanced a year ago are being denied. People who bought pre-construction homes are being told their original approvals no longer apply. And people trying to move, divorce, downsize, simply move from variable to fixed rates are being told we can't help you. That's where vendor take-back mortgages come in. A vendor take-back mortgage, or VTB, is when the seller of a property finances part of the purchase directly for the buyer. Instead of getting all of their money up front, the seller becomes the lender for a portion of the deal. These were really popular in the 1980s during the high interest rates and are seeing a major resurgence now. In the GTA, 1 in 5 condos sold in the first quarter of 2025 involved a VTB. That's 5 times higher than just a year ago. And it's not just Toronto. Real estate lawyers across Canada are reporting spikes in VTB inquiries. In Vancouver, in Calgary, in parts of Ontario's cottage country, deals are increasingly being structured with some version of seller financing, especially on homes sitting unsold for 60, 90, even 120 days. So why would a seller offer this? In many cases, they need to sell, and quickly, usually because they can't afford the payments. So rather than hold the property and keep paying the mortgage, taxes, condo fees, sellers offer a VTB just to get the deal done. For the buyer, it's not ideal, but for many, it's the only path to ownership left. Renters often see VTB mortgages as a way to convert what they're already paying in rent to an equity building monthly payment. The logic is simple. If you're already paying $3,000 a month to a landlord, why not pay the same to a seller and actually own something? Then there are those who want to buy but don't have the credit history, income stability, or employment background that a bank stress test demands. Maybe they changed industries during COVID. Maybe they've been juggling contracts or freelance work and now they're being told they don't qualify, despite making enough to cover the payments. For them, a VTB is often the only option that doesn't involve borrowing from a private lender at 10% or more. Some buyers are entering into short-term 2 to 3 year vendor take-back deals, hoping that rates will fall and they can refinance through a bank later. Others are knowingly locking into high-interest VTBs just to close, not because it makes financial sense long-term, but because it's the only door that hasn't slammed shut. This is a canary in the coal mine. When both sides of a transaction are desperate, one to sell, one to buy, and banks won't touch it, the system is signaling stress. In Canada, we don't often use the term foreclosure. Here, most lenders use something called power of sale, which allows the bank to take possession and sell the home without going through the courts and it makes the process faster and less publicly visible than in the US. But even that takes time. Depending on the province, it can take 6 to 12 months from the first missed payment to the final sale of a home. And because these aren't tracked in a centralized, public, national database, stats are harder to come by. What we do see, like the data from the Canadian Bankers Association, it only covers mortgages that are 90 plus days past due. According to the Canadian Bankers Association, as of March 2025, more than 0.27% of all mortgages were 90 days or more behind on payments. That's up from 0.12% just a year ago. In other words, the number of seriously delinquent mortgages in Canada has more than doubled in a year. To put that into context, that's 2,600 to 2,700 households in the GTA alone. And what we don't know is almost more concerning than that. These stats are only from traditional lenders, the big 5 banks and some major credit unions. What we don't have is accurate data on private lenders who are now issuing a growing share of Canada's mortgages. People denied by the banks are turning to private lenders who charge interest rates of 10, 12% or more, with upfront fees and balloon payments. If just a fraction of those borrowers default, it won't be captured in the official data until homes start hitting the power of sale listings. The system is leaving people behind, and fast. Many families are quietly choosing between food, heating, car payment, and their mortgage. Others are maxing out lines of credit or borrowing from family just to hold on another month. This is where it all connects. Vendor take-back mortgages, foreclosures, and the unseen toll of private lending aren't separate problems. They're symptoms of the same underlying issue. A housing market built on cheap credit, now buckling under the weight of normalizing interest rates. These aren't crisis-level rates by any historical standard, but in a country this over-leveraged, even normal becomes unaffordable. So where are we in housing right now? We're in a place where even people with good jobs and stable incomes can't buy or refinance, where homeowners are running out of equity, renters are running out of options, and families are quietly hitting the end of their available credit. And the banks, they're tightening the rules, raising the bar, and shrugging at the fallout. This isn't sustainable, and everyone knows it. Thank you for watching. Part 3 drops next Tuesday, and we'll be looking at where this is all headed, who is getting left behind, and what comes next in this entire system. Have a wonderful day.